open should public companies have to be about money? Now, this is a hot debate going on right now. And I actually changed my mind during the course of reporting this story for the latest issue of Business Week. My favorite thing about being a reporter is that I feel like it really always makes me think. The issue being discussed is something called quarterly earnings. President Trump recently posted that quarterly earnings were really bad for companies and we should go to 6 months like most other countries do. Every 3 months, companies have to essentially open up their books, show what they've been spending money on, how much money they've been making. Most countries around the world make public companies do this every 6 months. In the US, we make companies open up their books every 3 months. And the logic behind that was it would make markets more fair. So if I'm buying stocks in my apartment in Brooklyn, and then there's a banker in Manhattan buying stocks on behalf of JP Morgan, the banker probably has access to a lot of information I don't. And so the idea is every 3 months, these companies have to disclose everything. That makes the markets more fair. That makes the gap between my knowledge and the banker in Manhattan's knowledge narrower. But quarterly earnings cause a lot of issues. So what happens is banks and analysts always cook up these numbers that they think companies should hit, and they're called the earnings targets. Like we think Apple's going to make X billions of dollars over the last 3 months. And if companies miss that, if they miss that target, it is a disaster. Huge sell offs, heads roll. And in fact, there's a great study about this. Back in 2004, economists Cam Harvey and Shiva Rajgopal talked to CFOs of public companies. Hundreds of CFOs had them take a survey. And one of the questions in the survey was, have you ever sacrificed shareholder company value in order to hit an earnings target? 78% of them said yes. And economist Cam Harvey said he actually thought the number might be higher. He said everyone we talked to had done it. They would put off a project, put off hiring because they just needed to hit these targets. That means the company's not operating as efficiently as it could, and that is bad for the economy. His co-author, Shiva Rajgopal, who's an economist at Columbia, actually came away with that study with a completely different view. He thought moving from companies having to open up their books every 3 months to 6 months would just make the gap between me buying my stocks in Brooklyn and the banker at JP Morgan way too big. He said it would open the door to insider trading. It would make markets less fair. Rajgopal makes a really compelling point. About half of all the money in all the markets in the world is in US markets. That brings so much value to American companies and the country. And once you start messing with that, we could lose our competitive edge. Part of the reason investors like investing in US companies is that they feel like the markets are more transparent. And if we move to 6 months, that might not be the case.